Good morning. Well, good morning, good evening, good night for some in Australia. Um, Welcome back to the trend following trading ideologues from Tampa, Florida, the center of the universe today and tomorrow. How can I say that? Taylor Swift's in town. That's how I can say it. And it's crazy here in the city and in my house. The women are very, very excited. And as well they should be. I did not get a ticket, and I will not be going. I know you're not surprised about that. More into the rock and roll, classic rock and roll, and reggae music, which Elon needs to improve. This opening music, I need to be able to choose the music I want to play, Elon. So please get busy on that. So it's been a fun week. The returns from March are rolling in. Everyone survived. I think the markets are fun and interesting these days. I have a lot of good positions on long short currencies. That's better than short only, except when we're making lots of money being short only. Long and short a few interest rates as well. Long a few. I branched out into the ETF world. Tips, high yield, junk, mortgage-backed, muni bonds, corporate, short-term, long-term on most of those. So that's fun. And some of those are acting a bit different chart patterns, slightly different chart patterns. I was wondering, since I'm not a hardcore math guy, I was wondering if some of those hardcore math people have ever sort of run this experiment of you have markets that are you create this data, synthetic data, and the markets are highly correlated, from 90 to 100% correlated, but you pick some random number generator and it chooses how many ATRs from, let's say, -3 to +3 that each market moves per day. So they're all correlated, but they don't all move the same ATR amount each day. And what would that do to the chart pattern? Would that create charts that don't look very similar? It must. Oh well. Yeah, so I listened to a lot of podcasts this week. We could talk about some of them. I like the Alpha Architect podcast. I tweeted some of that. They're into ETFs, and they're promoting ETFs for people. I like that idea. I'm coming out with my own ETF. I put the symbol in my Twitter, bio at the top up there. And it's going to be about 3 months. We'll have the Chesapeake 300 market trend following program in ETF format as well, as close to the private fund as possible. And so that's going to be kind of fun. And that was a really good podcast. And then I listened to another podcast from a fundamental value guy that loves Buffett. And he's a friend of mine from back in the day. We went to church together in Richmond. He went to UVA like I did. Tom Gaynor, smart guy, incredibly successful. People love him. He's like a Buffett type guy, and people love that stuff. And so it was really interesting coming at trading from two different methodologies, trend following and value, let's say. But a lot of the quotes I got from him were very similar to things that I would say, like let profits run, how important it is to maximize those profits and not to get out of profits too quickly. We like to overlay it with long-term trend following, which is going to average about a year or two holding period. But I think those value guys hold on for a lot longer. But still, with the Alpha Architect and with that podcast, the other podcast as well, there was a lot of good stuff that I could tweet and twist it into my trend following worldview. Then finally, Mike Melisinos and I, we had our first podcast yesterday. I have a hard time watching myself or listening to myself, so I just listened to a couple minutes. It looks okay. I like that it's video. It's video on Spotify, which not a lot of people do, which is kind of crazy. I mean, the video is really fun. It'll be out there on YouTube hopefully soon. And we're just trying to have fun. He doesn't want to talk too much specifics. I like talking more specifics. So, and he was pretending the whole time that he's not going to win this fantasy hockey league, which ended last night. So he won it going away. Easy victory for him this year. I'm really disappointed because it's kind of not as important as me continuing to have better performance than him in the trend following fund world, but just in this trivial, I still want to beat him in this trivial pursuit of fantasy hockey. He quit fantasy football. So I've got to go back to the drawing board because I had a tremendous fail this year. My spreadsheet approach of drafting and building my team failed me miserably. So I got to figure that out. I've got a long time to do that. I know I can do it. But anyways, let's start with Oleg. Good morning, Oleg.
Good morning, Jerry. Good morning. I don't think that. Good morning. Good night, Richard. Good morning, Brian, Bruno, and other guys. Jerry Smith. I'm very happy to, as Seth, I'm very happy to be here. Of course, it can't be anything else. It was very nice week because I'm a trend follower and I have such a philosophy, such a mindset that if I am a trend follower, I'm a happy person. So it's in every circumstances I'm a happy person, and this circumstances really good. They're good trending period now, and I want to say that I was thinking. By the way, maybe this week I was thinking about the problem that Jerry said right now about that we have fully correlated, maybe 90% correlated markets with different average true range movement. Maybe not much different, but different. And I'm not a heavy math guy, but I'm sure that it adds a diversification bonuses. Yes, it really adds because I saw this last week in practice. I saw that in currencies, in some stocks, that the answer is that there are diversification bonuses because of this moment. So my happy moments are starting our discussion, which I'm waiting for all week, every day, maybe even every hour when I'm not sleeping. So let's get started.
G'day, Oleg. G'day, Jerry. And Jerry, listen, congratulations on your ETF. That's a major achievement. So, you, like Andrew, have democratized the CTA space by allowing retail investors to get into the ETFs on your product. That's a great move. So could you go into the story of the process you used to get this up and running?
Sure. The Alpha Architect guys, if you follow them a bit and listen to the podcast, the recent one with Meb Faber, I think that they have like 30 ETFs. That seems to be kind of something that I'm noticing that people do. Let's just do everything. Well, we're going to start with one, and they will do a white label for you as well. So they'll kind of, if you can maybe bring a little bit of cash to the table and your system, then I think they can help you make it happen. And so we did not partner with them, but we do have an advisor with a sub-advisor. And so we're not going to have to do all the not fun stuff. The advisor will do the compliance and the daily reporting and be responsible for things like that. Well, I'll just have to trade it, which is nice. Now, it was sort of a challenge for us to find a market maker. So that was our first step. Like, we need to find a market maker who, when someone wants to buy the fund, they'll take the opposite positions of Chesapeake and make a market for this person who wants to buy. And so finding a market maker who could handle currencies, the over-the-counter currencies, we do a few of those. We do a lot of futures, of course, and stocks. So they have to do these opposite positions in 300 markets pretty simultaneously, right? And so to find a market maker that could handle all of that was difficult, surprisingly. Most of these guys said, we can do stocks or we can do futures. And so when you look around at managed futures, CTA, ETFs, you don't see single stocks and so maybe, well, they don't like the single stocks to begin with, but it is kind of problematic. So we finally found one. They said, bring it on. We can do whatever you want to do. And we're saying, what about these illiquid markets? Sunflower seeds, maize, milk. They said, bring it on. We can do it. So I'm going to go in a little skeptical. Maybe it won't be 300. It'll be 290. But they're like saying, nope, 300 is what it's going to be. And so we are going to go through this process of the regulatory filing and the 3 months that it takes the government, the SEC in the United States to process this. We'll be up and running. Now, how is the private fund going to exist with the ETF? Why do we need both, and how can we have both? Because I'm going to trade them the same way. You're going to except I'm going to trade the ETF a little bit lower leverage, so a little bit safer, less volatility, and so the fees in the private fund will be a little higher because you'll be getting more juice, but it'll be worth it to pay it if you're high net worth. And if you're not, you can go into this ETF. And someone did some research. I guess they follow ETF filings, and a few people have emailed me or posted on Twitter about this fund. Not me, but someone else. And I guess the filing is to say that the symbol and is not available yet, but I think it is available. I think we've chosen our symbol. I posted it on my Twitter page. So it's TFPN, trend following plus nothing. What do you think, Richard?
I like it, Jerry. That's a great one. And so the aim, say for a retail investor who wanted to get into this ETF, would you be saying, regularly contribute, or would you be saying lump sum in? How would you go about it?
I prefer the regular contribution, unless we're in a drawdown, making new lows. You can kind of, it's the only investment I would advise to, buy the dip and dollar cost average, let's say. That's fine, but I like the piecing in. I think piecing it in is a good idea. I had something else I was going to say. I forgot it, but yeah, it's going to be fun. Oh, I think one of the things about this ETF, I've always thought this, and I read something recently, or I talked to someone, and they agreed with me. One of the great things about this ETF is that it's anonymous. You can buy it. You don't have to talk to anybody, and I think that kind of helps. Clients who make a big commitment, they've got to meet you, they've got to love you, and then you're going to have this due diligence and this interview process, and it's a big deal. Then I don't like it. You're no good. I want to get out now. You got to call them up. You got to say, hey, I want to redeem. And this is just, you don't have to talk to anyone. You don't have to admit to anything. You can just get in anonymously and then get the hell out when you don't like it. And I think it appeals to certain personalities. And it would appeal to me. I don't want to go through this hassle of dealing with people. So I make it my business to follow the positions of stock traders. So anyone in the U.S. who trades, I think $100 million worth of equities, they have to report their positions monthly or quarterly. And so I can get that information. It's delayed. I don't really care if it's delayed. I'm not trying to copy them. I just want to see what's on their mind. What stocks were these people buying? And then you can also see who's buying, these mutual funds and ETFs. And I follow who is buying Andrew Beer's DBMF, and it's a lot of institutions, and probably people who don't want to admit, like, I'm in managed futures, I want to see what this is about, I want to get this exposure today, I may want to keep it for a year, the rest of my life, or a week. And so you can go in there and see that there are some heavy hitters who are buying, these ETFs to get this CTA exposure. So, and I think our product here is fairly unique. You've heard me say it a million times, and I won't shut up about some of these things, which is what the world does not need is, or should not be going for so much, is long stocks, buy and hold, long bonds, buy and hold, 60-40, but I'll add a 5%, 5 to 10% allocation to CTAs. Well, the allocation needs to be like 40%, let's say, or you're not going to move the dial very much. And the CTA trend following deserves to be the bulk anyways. So our idea is, no, what you need is to sell some of that 60 and put it into a fund that's going to trade 50%, 40%, whatever, long and short single stocks with the trend following. And that's and then the balance will be the currencies, commodities, and interest rates. And that will help your portfolio. That'll help with crisis alpha because you won't have as many crises. You'll be trend following the stocks. And who's going to argue with me about this? The CTAs themselves? Like, oh no, you don't want to do that. Stay with what you've got. Keep your 5 or 10% allocation. We love trend following, but we don't believe it can help with your single stocks. Really? So we're going to give people the perfect portfolio, and you can protect those stocks in a better way than allocating to a CTA. As much as I love that idea, allocate your stocks to trend following, and so I can take small losses and let profits run.
I was just wondering, the plan going forward, when you make changes with, say, Chesapeake underlying, will those changes be automatically reflected in the ETF? Are you sort of going to effectively replicate your Chesapeake program with the ETF, or is it based on sort of a 300 level diversification now? You plan to keep it that way, fairly stable? How do you plan to go forward with it?
That's right. It'll my plan, hopefully, if I can trade all those markets, would be it'll have the same exact positions. Well, it'll be lower leveraged. But so when I buy soybeans for the private fund, I'll buy 2/3 of that quantity, AUM adjusted for the ETF. So it'll run in parallel. I have a lot of experience of trading 100 managed accounts at one time in parallel, based upon different AUM, but mostly all with the same leverage. Although I have experience with 1x programs, 2x programs, and things like that. They're kind of a little challenge as well. But to the best of our ability, every single day, the ETF will have 2/3 of the performance of the private fund. So that's the plan. We have 3 months to get our act together and make sure we can handle all that stuff in the right way. So I think it's going to be a fun project, and I have some other ideas as well that if we want to come up with some more, I have some. I think the most important thing is it needs to have a reason to exist. I'm so totally dedicated to a diversified portfolio. I've experimented with less diversification before, and I've just never been happy with it, never been able to sustain it. Clients eventually give up on it as well. But there are some reasons to have, for instance, a currency only, stock only, bond only, commodity only, let's say ETF. There's some legitimate tax reasons to do things like that, which we would consider. But if the ETF raises billions and billions and trillions, maybe, we'll just concentrate on ETFs. I think it's kind of a come down, for having been raised on 2 and 20, and then 1 in 20, and then 1 in 15, and trend following certainly our strategy deserves a decent fee. I'm not in favor of high fees, and I'm not in favor of huge incentive fees. They can distort performance and be way worse than a management fee. I know people don't agree with that, but I've talked to clients and I've experienced it, and it's just 100% true, right? So if you've got a good manager and you're confident with your manager, pay him you should ask him, can I pay you 2 and 0 or 3 and 0? You're going to pay less money than a huge incentive fee if he makes money. And if you don't think he's going to make money, then don't invest.
I can see now why Taylor Swift is down in Florida. You're obviously getting her to launch your ETF, Jerry.
There was a rumor on the social media that she was going to rent a house on my street. So Tom Brady lived 3 doors down for a while when he played for the Bucks, and then some of the famous Beyonce and I can't think of the guy's name, but some of the other famous singers have stayed on my street as well. So the women in my family got into the golf cart the other day and started riding around the neighborhood trying to find her. And they said they saw a lot of police. They got afraid and came home. So it's going to be quite a night. We'll see what happens.
Actually, a question I'd love to talk about tonight is I'm sort of interested in seeing what are the mechanics of trying to get into the Chinese futures markets without the underlying, liquidity issues, geopolitical issues, etc. And if anyone's got any points they'd like to raise here, I'd be very interested.
That's funny. Maritza and I talked about this yesterday or the day before, and Maritza's the expert, on how to trade China. I think he's doing it, but do you want to speak to that, Moritz, or I can talk what I know? I think you have to have a presence in China. I think Winton has a presence in probably Florin Court as well. Office in China. They've made friends with with the government and the regulatory bodies. For Americans, another way of going about it is you can do a swap with a bank, Goldman, Macquarie swaps, where they'll do the trades themselves, put it to you in a swap, charge you crazy fees, and there you have it. There you have China. It's not available for U.S. clients. So for American companies who are doing it in China, American traders, or who are going the swap route, pretty sure they have to set up a Cayman fund or a non-U.S. based fund and that would cater only to non-U.S. clients. But it's quite a deal to do that, and I would love to do it. I just need to, and they keep promising that it's going to open up and be more available to to the world without having to jump through these hoops. But I think they're pretty slow.
Thanks, Jerry.
Did you understand my example, Richard, of creating synthetic data and creating very high correlations amongst these pretend data of these pretend markets, but having the different movements each day vary in terms of ATR?
I was trying to get my head around it. So the only thing that changes is that they're highly correlated, but the only thing that changes is the level of volatility with ATR. I'm not sure what that does. I've got no idea, Jerry.
Hey, hi everyone. Glad to be here. First of all, congratulations on the ETF, Jerry. It's really nice indeed. On this issue of highly correlated series with different volatility, from the system perspective, it really doesn't matter if it's higher volatility or not, does it? Because you're filtering through the volatility on the system when you base your positions on the ATR level. And anyway, I believe we have a quote unquote real world example of this when we look at the interest rates. If you take 2 years ahead interest rate, it will be highly correlated with, I don't know, 5 years ahead, 6 years ahead, whatever. And the difference here is that the longer duration interest rates will have higher volatility. Perhaps you can start from there and not need to rely on synthetic historic series.
And I want only to say that it gives some benefits, and 100% I'm sure that it gives some benefits, diversification benefits. Of course, we use universal average to range for stock, of course, but for example, one stock can move 2 average to range, and the second stock 3, very highly correlated stocks, 3 average to range. And so we may have, because of it, initial stop loss or maybe a signal or something like that. My English is not perfect here, maybe, but I'm sure that there is some benefits, not very huge maybe benefits, but we have diversification benefit in this, I'm sure. Not much, but we have.
Yeah, but see, I use an ATR for my entry, so immediately it's going to normalize for that level of volatility. So I just can't see any difference.
Yeah, I think Oleg was onto it. Okay, so here's what I'm trying to say. I need to be a little bit better explaining myself. I think I'm pretty sure. I don't want to show my ignorance here, but like correlation is just movement in the same direction. So we got these two markets, and they're moving in the same direction every day. Every day they're moving in the same direction. However, one market consistently is positive 1 ATR, and then the other market is positive a quarter of an ATR every day. And then it reverses. One market, the first market is now losing 1/4 per day, and the other market is losing 1 ATR per day. So my question was, given that markets can be correlated, and yet their ATR movement could be much different than the chart pattern. The chart pattern, that's all, the chart pattern. So as Oleg was saying, one stock I got stopped out of. The other I didn't get stopped out of based upon its different ATR movement. And so I guess I was thinking, yeah, that kind of puts the nail in the coffin of correlation. Markets being correlated doesn't mean we shouldn't trade them, because our overlay of trend following will create different positions with markets that are highly correlated. What do you think?
Hi guys. Hello, Jerry. Congratulations on the ETF project. It sounds very exciting. Now, the fact that correlated markets could have different volatility amounts, that would impact the way I trade, my short-term system. So, as quantitative traders, we do have lots of tricks on the hats, okay, that not all the time is visible to, to, let's say, more long-term traders. And one of the things that I was listening the Rob Carver's interview, and he was talking about this Sunday, the combining long and short volatility purposefully, so that to increase the volatility of the position. So when the volatility is very low, the position size is not going to be very high. So basically, he's doing something else artificially to avoid overshooting of the position size and to minimize the leverage when the volatility is low. So, you know, so and when running the short-term systems, so I use a leverage cap on each position. So my leverage is never more than a percentage of my account equity. Let's say 20%. So a position will never increase the 20% of my account equity. So if there are two trades, let's say crude and Brent, and if their volatility is going to be higher, this is going to impact my position size and the associated profitability, because the lower the vol, the higher the position size. But because of the cap, basically my risk is going to be lower, because I will cut that position size at a certain threshold. So yeah, I mean, so that would be the direct impact into the way I trade, and it translates into the fact that the way I trend follow the volatile markets, I will make more money, because volatility will bring lower leverage in the way that I trade, and the position sizes will not be impacted by the cap that I have introduced. So I think it's slightly different ways of looking into it, because short term, basically you can maximize the leverage if you don't have any tricks under the head. So you need to do something else to successfully manage the leverage, and many quantitative traders does what I've just mentioned as well. So it's not specifically to me, but Rob is doing slightly different, I'm doing slightly different, and other quant traders are doing slightly different as well. Thanks.
I think I'm more like Rob in that let's say we've got let's say we take a very high volatility example like cryptocurrencies. And let's say we've got another hypothetical market that has exactly the same price profile as cryptocurrencies over the long term, but let's say it's quarter as volatile, but it's perfectly correlated, but just quarter as volatile. So because I'm taking a standard risk bet, let's say of $500 for an individual trade, what I'm doing with my position sizing treatment is I'm using ATR, like a 25 period ATR, and I'm using a multiplier in that ATR to define where my stop level is. And then I'm risking $500 between the entry and that stop level. And so what happens is if I'm trading an instrument that is quarter as volatile as cryptocurrencies, it's going to get 4 times the position size of that cryptocurrency to risk that same $500 bet. But it's normalizing the process. So there is no difference between the instrument that's quarter as volatile as a cryptocurrency. So with the approach I'm taking, if they have the same level of correlation, they're treated, but different levels of volatility, they're treated exactly equal. So I'm not really seeing a diversification benefit there. I'm just seeing something that is quarter as volatile. I'm trading with 4 times the position size.
Yeah, exactly. But I don't want to be trading it 4 times the position size. Just because I'm short term, just because my ATRs are not like 10 ATRs, so it's way lower than 10 ATRs for short term trading. Of course, you're a long term trader, so you're using daily bars is an advantage. Plus, on top of it, very large loose pants, and when you combine that, your overall leverage is already very low. So because I'm nimble and fast, so I need to somehow manage the leverage, and so that's the way I'm doing. And Rob is doing slightly different by combining long-term and short-term vol as well. So it's just another angle, I guess. Richard, thanks.
Jerry, how do you do your position sizing treatment?
I think I do it just like you do. Turtle 101, and I haven't changed. I risk the same dollar amount every trade. Every trade has the same ATR stop loss, and I lose 12 basis points. I have a healthy distance. My distance from exit, my stop loss distance used to be 2 ATRs back in the turtle days. Now it's much greater than that. So I just optimized it out. And as I've said before, when I optimize what's the best stop loss, it's really not taking small losses necessarily, because the 12 basis points I lose on every trade, if it's if it goes the full distance of a loss, is a function of trading so many markets and not a function of the stop loss being very, very close to the market. So it's not so much a small loss, or it's more of an optimal loss. And as I've said before, when I just optimized it, and the computer says, oh, you make more money if you use a stop loss no less than X, but it can be, a bit higher. It kind of gets to a level where it's not going to get any better. You can take bigger losses, but it would just be for diversification purposes. But you can definitely take losses that are too small, in my opinion. You make less money. I remember Rich visiting me in Richmond once, and, I was asking him after a couple of years on my own, I was like, why did we use those stop losses, the 2 ATR? Because when I tested it, it was very suboptimal. Trying to choose my words carefully. He goes, oh, that was just my personality. And I was like, oh, my personality is, trying to force myself to do things the computer likes more than I like. And, but I do see there could be some benefits in not doing that optimization and sticking with it, or doing multiple 2 ATR, 3 ATR, 4 ATR stop losses. But at some point, I can't break up my trades, but so much. Trading 4 systems, and I don't want to trade 20 systems. Okay. So, and then when I did the optimization, I noticed that without a stop loss, the average loss is the same as my stop loss. So I thought, okay, that must be good. So I sort of settled on that particular stop loss. And then I let it go the distance, and I risk 12 basis points. And you say, wow, that's a superpower. It can never go wrong for you. Well, I'm in a lot of currencies, and they all go down or up some days, and interest rates as well, and stocks as well. So you can't just get caught in a situation where, you're trading small, but you're trading so many markets, you're still going to take a hit. And then, of course, once that trade is put on, I never look at that ATR again. It's irrelevant. I just wanted to normalize the losses. You see, back in 1983, when I heard normalize the losses, I was like, that's a big deal. That's interesting. Write that down. Now, people have, they don't care about that as a reason. They just say, oh, well, if you have a certain risk at entry, common sense, keep that risk the same throughout the whole life of the trade. No, you got to let profits run. And it's normalizing the losses, but that's not PhD-y enough. That's too old school. So they don't want to do that. That's fine. And then you just let it go, and that ATR is irrelevant, and you make it, and it's some of those short-term interest rates that we sold a long time ago, the ATR, oh my God, it was 5. And now it probably got up to 20 or 30. And these small positions that we put on, because the ATR was so small a year or two ago, they've turned into monster positions. They're destroying the performance every day. They're helping, then they're hurting. And it's just driving you crazy. And this is what managed future CTAs want to get away from, being driven crazy. And I just want to do what the computer says, oh, this is how you make the most amount of money.
Yeah, I like that, Jerry. The normalized Solosis is important to me because that's keeping the losses all linear. And so when we talk about normalizing the losses, we're looking for a sweet spot where you need to allow maximum degrees of freedom to catch those outliers without getting an unnecessarily whipsawed out of your trades all the time. So there definitely is that sweet spot. And I really liked what you said in that you found that when you undertook your tests without a stop, it fell on a particular value, has the optimal level of adverse volatility, and that's effectively where you're placing your stops anyway. And that to me is exactly where that sweet spot is, and I like that approach.
So in terms of, just to mention, that sweet spot is very long-term specific concept, you see, because the drawdowns are already large. So using a relatively larger ATR helps, in my model, in my long-term model, helps me to keep that drawdowns under the control. But, while trading shorter term, the drawdowns are not that high. So we discussed this in the past. So one of the benefits of a shorter term trading is you're not going to see more than 40% of drawdowns if you choose to do that. And so this gives you an option, basically two options. Either you're going to use a sweet spot ATR and have a much more smoother equity curve, or you may choose something else slightly less smooth. So you might actually want to be a little bit less smooth equity curve with a tighter ATR, and that will make more money as well. So I think what I'm saying is you got an option not to choose the sweet spot ATR with shorter term systems, because the overall maximum drawdown is manageable per se, if I'm making any sense. Thank you.
Well, I think it's just just parenthetically, I think it's important to, on this basis, to let us know which drawdown you're talking about, total AUM drawdown, which is not going to be impacted by the stop losses probably too much. It's going to be, in my case, since I don't vol manage, my drawdowns are going to be more correlated to the winning trades reversing like March. And then it's very important to use, for me to understand what's going on, this idea of stop loss. That's not versus a trailing stop. Trailing breakout exit, profitable trade more than likely, and you're getting out to the 100-day low versus stop loss. Stop loss. We're losing money. It's a multiple of ATR. So I get confused. However, okay, but that's just parenthetically. I just wanted to say that, look, one of the things that's highly important to Richard and me, and is we play an easier game. We've set it up to where it's easier. I don't like it to be too hard. And that is, we're using a trade level of closed trade equity and not total AUM. And so managed futures CTAs, they're defending all-time highs all the time. Super difficult, super duper hard. And if you're going to do that, you cannot do it with the most robust strategies like one entry, one exit, and one stop loss. You have to do other things because you can give back too much profit. And so for Richard and me, we can defend our trade level, our capital, our trade level, our closed trade equity, all three of those words are the same meaning, by just taking small losses. And our drawdown on the big winning trades has no impact on preserving our capital, our definition of what our capital is. But one thing that does have a material impact on preserving our capital, the way we look at it, and our risk of ruin, maybe some other things, is the percentage of winning trades. It's already at 40 or low 40s at best. If you're letting profits run and you have the perfect stop loss, it's still at 40 something, right? It's not 50, and that's eating into our capital. And so we don't like that. So the size of the stop loss, the distance of the stop loss, 1 ATR, 2 ATRs, 10 ATRs, let's say, that's the range, let's say, something like that. 10 sounds large, right? Well, it's going to have a material impact on the percentage of winners. The closer your stop loss is to your entry, your winners may get down to 25% or 20%. Now, they're a quarter as large, granted, but there is a bit of slippage because I think the proper way to handle re-entry is at the highs. Right? You got to wait to the high again. So you buy, it goes up 2 or 3 or 4 ATRs, it goes down, you get out. Then you got to go back to that new high level, 4 ATRs from your initial buy level. And so you can see how this can kind of get out of control, and you're building up these losses, and the market you'd have a winning trade if you just hadn't touched it. And so I think that you want to have an optimal stop loss that is going to really have a positive impact on that winning percentage of trades that that's going to be 40 something, low 40s or mid 40s at best if you're doing it the right way and not cheating. Sam posted this tweet yesterday about yeah, this was kind of silly, I think. I mean, Sam wasn't being silly. He was describing other traders, of course. Sam, he wouldn't do anything like this. He was sort of saying like some traders will, if they have 2 or 3 losses in a row in the same market, they will do something different the next time to verify the trend. Now, look, you can't verify these trends. You get in, you follow your system. Who the hell knows what's going to happen? There's no way to, well, now I'm extra sure this is going to be a profit. I've had 2 or 3 losses in a row. Don't want that to happen again. Now I'm going to do something a little bit different, sample size, and I'm going to verify it and confirm it more. No. In fact, my research has shown that the more losses in a market in a row, the better the next trade is. So the trade is getting better. Don't wait for more confirmation. Get in quicker. I get in quicker the more painful the losses in this particular market is, the more painful the trading has been in a particular market. Cocoa. Cocoa, we hadn't made money in 10 years. I was slamming those breakouts so quick. And I was like trading London cocoa, for God's sake. I wanted a double portion of this pain. And so look, these losses are small. That's the reason you don't have to care so much about them. I mean, look, I've already said, get that stop loss at an optimal level, care about it. But once you got your system in place, you're fully diversified, don't stress about these losses. If these losses are material, you're not trading enough markets. You're trading too large. But focus on getting in that trend and staying with it and giving each market and each trade the ability to rise from the dead and become a winner. I mean, you should see some of my trades. I put it on, I buy the high, it goes 90% of my limit down to 90% of my max loss. I'm like, well, that sucks. It comes right back to life and makes a ton of money. I mean, this happens all the time. And then the same thing happens. I get out with my loss, and it does the same thing. It goes right back up. So you're going to get your fair share of these 99% you almost got out with your max loss. And then you're going to see it reverse and become a wonderful trade. I think by and large, when it's certainly riding winners and letting profits run, your main concern should be, I'm really afraid of getting out too quickly. And I think that's the key with the losses. Look, when it hits your stop loss, you're done. Get out. But before that, try to ignore it and create a systematic approach with this philosophy of, I am going to give each one of these trades as much room to express themselves and make money for me. They're doing this heavy lifting and this work for me. At some point I'm going to get out, but at some point I'm going to let them just try to hang into this thing as long as I possibly can. And there's no reason to get out. These losses are small. They're small by definition. They don't really matter. If they're not, you got other problems.
So, when Jerry Parker speaks like that, it sounds too easy. And I think, someone needs to raise a flag and just to say that, just be careful, just because, it's a totally different level of mastery to make such a complex process to sound it easy. So, that's one thing that I would like to talk about. The second thing is, this entering quick. So you're actually having multiple losses in a row. You're going through a losing streak, and you're entering quicker. On the more losses you have, you're entering quicker. So this sounds like a cheat sheet of a martingale position sizing uh, technique, which is of course not advisable to anyone else. So when you go to the casino, you lose $100. Next bet, next time you bet $200. If you lose 200, next bet you're each time you're losing the money, you're doubling it on the next time, and you know that before your money loses steam, you're going to come back and make a huge winner, because every time you're betting twice as much as you are losing. So there's actually there's a similarity between entering quick and this martingale strategy, but Jay Parker is doing quite a smart way. So his downside is not nowhere near as much as a martingale position sizing strategy. So that's actually very interesting, and I think he's able to do that because Jerry Parker talks a lot about the cutback rule. If he's losing money big time, so he cuts back his position sizing uh, more than the drawdowns that he's having, which I do have the same rule in my system. So if I'm, down 30%, I've already cut back my position size by 60%, twice as much. So it's that cutback rule is basically is something else that keeps you in mind. And if you have a cutback rule like that, yeah, you can go ahead and enter quick, because the more drawdowns you're going to have, you're going to cut your position size smaller and smaller. I say it's a very smart way of doing that. Now, the other thing that
Oh,
actually,
let me answer that, and then I'll let you get back. Okay, so Alp is my friend, and he's too nice to me sometimes. But my wife calls me Jerry Parker, so it made me smile, but not in a good way. Like, he was bragging on me a little bit, and my wife, she's dressing me down usually when she calls me by my full name. But okay, so thanks for mentioning it and drawing that example of Martingale. But it's I overstated it a bit. So let me be more clear. So it's not Martingale, and I wouldn't recommend that. And I don't really sit back and say to myself ever that, well, it's me doing it, so I wouldn't advise anyone else to do it. Only, I can do it, or people with my experience or whatever. Okay. No, I would never say that. I would never advocate that to anyone. I don't advocate it for myself. My systems are super simple. They don't have very many moving parts. And I advocate that for others, and I do it myself. It's shocking, shocking. There's no one on the spaces or in the business who does less than I do. No one. Because I do as little as possible with these markets and with these systems. Okay, so the rule is not a martingale changing my size. I just have a breakout combined with another systematic rule that has a tendency to, so that rule needs to be elected on the same day of the breakout. And if the chart pattern or the market has been very choppy, they have a tendency to signal on the same day. Okay. If it hasn't been choppy and it has been kind of a profitable market, the second entry will delay the breakout. So I will bypass the breakout and then get in later when the second rule is satisfied. I need more trend. I need more trend if the market has been good, a V top, a V bottom. So I'm going to be slow getting into long interest rates because they've been really good. But it's systematic, and it's not messing with my trading size. It's a simple rule that says, okay, if you have a good market and the structure and the tilting of the chart looks really trendy, then it's going to bypass the initial breakout and wait for the second entry rule to be hit, and then we'll all get in. But then if it's been very choppy, like Coco, which is 10 years of consolidation, then we hit the breakout, and that rule is, it's been satisfied. It's been satisfied for years, and but it's a very simple thing that is in the public domain But that was an old turtle rule too, is that the more choppiness, the more false breakouts. But the turtles were way more discretionary to some degree than I am. I'm strictly rules-based, no discretion at all. These rules don't always work or can't be really explained. They don't need to be explained. I just explained it, but it doesn't need explanation. It just makes the trades a bit better. All right, Al, keep going.
Right. Thanks, Jerry. So the other thing that we usually talk about is the winning percentage. Now, in the trend following space, there are many traders in different platforms, podcasts that talk about this 40% winning rate and 60% losing rate. So that 40% actually has become like a, gospel, pretty much. So, it sounds like to be able to understand whether it is a good trend following system, you need to be somewhere else around 40%. And, you know, but actually, the more people will come to the party and start actually applying these systems, and the markets become more random over time, it's more likely than not that 40% is not going to withhold over the years. So that's one thing, just to be aware that 40% is just another number. So, I'm a big proponent of using sometimes 35% or 30%. And the difference is the smoothness of the equity again. So 40%, if you do that, in my systems, I'm having my maximum drawdowns or average drawdowns are smaller. And if I use less choppy systems like 30% or 35%, I'm making more money. But what happens is that comes with a cost. So I'm ending up with more average drawdowns and maximum drawdown on the systems that I am testing. So so I'm there is no reason why we need to stick to that 40%. It's just another number. So really, what does it mean is our psychology is embedded into running this system. So for me, that 40% means our psychology. We say that this is a discretionary system, but actually, as far as I understand, it's not a discretionary system because our psychology is choosing the system's parameters while designing the system. So 40% is a very good example. So a psychology, a human brain is saying that, okay, I want to run a system with a 40% hit rate. Once you do that, your psychology is embedded within that automated process. So actually, it's no longer automated. Your psychology is a huge part of it. And what's wrong with choosing 30% or 35%? Well, it is psychologically a little difficult. Yeah, but it's still possible. And so what about 20%, 25%? As long as you're able to take all the trades, if you are 100% sure that you're not going to miss a trade in your execution, and execution is hugely important with trend following. That number, I would say, is just how much your psychology can tolerate. There is no 40% systems are not necessarily better than 30% systems. It's just psychologically easier. So we can combine all the systems that we are talking with the same principles and make it 30% and still take all the trades and make it work as well. So, but everyone else is talking 40%, not only in this forum, but everywhere else, because it just becomes 40% becomes the holy gospel, but actually it is not. Thanks a lot.
No, I don't agree. I wanted to mention something else before I talk about that, and that is the cutback rule. You brought up the cutback rule, and so yeah, in a way that I don't like. I wouldn't think of the cutback rule the way you mentioned it a while back, but I don't want to use the cutback rule. So I'm never going to sit there and on purpose say, well, trade larger, trade with bigger stops, smaller stops, increase position size, And it's a little sketchy. It's not the best thing to do, but I've got this cutback rule in my back pocket. No. The problem with the cutback rule is that you're not doing a system trade. And I worship the holy grail of doing all the system trades. The cutback rule and most of this money management overlay is not, in my opinion, a system trade, which means that it doesn't have a great sample size. So I have to do it to survive, but I don't want to do it. And to some degree, if I have to do one cutback trade, maybe I have system failure. But if I'm doing cutback trades frequently, more than once a quarter, once a month, once a year even, I got problems. I'm trading too large. I've got some issues with my system. I'm not diversified enough or something. But when all hell breaks loose, like COVID, okay, you don't have anything wrong with your system, but now everything is losing multiple ATRs per day, every position, and the ATRs are expanding like crazy, and I'm down 10% in 2 days. All right. It's discretionary, but I only use it once every 2 or 3 years, but I don't ever want to use this cutback rule. Okay, now the 40% is a result of a back test. So it's not, I don't even know, I've never even thought about let's target 40%. Can one even target 40%? I think the breakout systems, one entry, one exit, and a stop loss, they're too wild and wildly. You cannot put them in a situation where you say, okay, let's tweak this and this, we'll take 45. Oh, but if we untweak it, we'll be happy with 25. No, I mean, who does this? I mean, we have no control over this win percentage, except if we on purpose make these stop losses so low that, yeah, if it's a 1 ATR, look, I've done a quarter of an ATR. Yeah, your stop loss your win percentage is going to be low. So it's the result of this back test. The stop loss comes first. The result is the win percentage. I'm not against people on purpose choosing tight stop losses where the result is going to be 30% winners, 20% winners, especially if you diversify. And I already said that, if you want to trade a lot of different stop loss links that are going to have different win percentages, that's probably better than what I do with just one. And I think to some degree, some people believe that you're getting more out of your trading and your system if you have tighter versus an optimized stop loss. And I'm not against that either. There's just no way to target. We're not out here, no one's targeting. You can't really do it because even if you go further than my stop loss up to 10 ATRs, it levels off at the same, pretty much the same win percentage. So at some point, you don't increase the win percentage any longer. So I don't think anyone is able to do that. Now, you can absolutely do it with vol management, correlation management, some sort of overlay that I don't agree with those overlays. One entry, one exit, and a stop loss there is no overlay. That's it.
I mean, of course, what I mean is using the stop loss is an overlay. On last podcast, Jerry Parker told the fact that he doesn't agree with what I have mentioned. I mentioned the fact that using stop losses is a mean reverting property, which because I'm looking into the maximum adverse excursion number, and I can see that there are trends that are actually reversing. So they are going well beyond 10 ATR, and they are passing these stop losses well and getting worse than the stop loss points, and then coming back and being a profitable trade. And by using a stop loss, of course, what I am doing is I'm cutting those losses short. Okay, so I'm cutting those trades short. I'm cutting those trends short. So I am not giving those trends enough room with loose pants or tight pants. And so as a philosophy, not using stops always, appeals me. But but I'm using one. That's because that's my background, so that's what I'm doing. But in terms of which I agree with what Jerry has said in terms of it is not possible to increase well above 40%. Well, it is very much possible to decrease it. That 40% you can very in my back test I can take it to the 35, 30, 25. The tighter the stop loss becomes, because stop loss is a tool and is an overlay tool, so it can actually, you can actually manipulate your percentage, trade winning percentage, and that's the moment where we see this game as a numbers game, right? So this is the moment where this game is nothing more than a statistical game. So each trade, and the more analysis we have done, whether there is COVID, whether there is 2022, March 2023, really doesn't make much sense if we see the game is just from a pure statistical point of view. If you just give numbers to everything else, forget about those 300 markets or the hundreds that I'm working on, and if you just, instead of calling them cocoa, crude, or apple, if you just call them 1 to 3, it's just you can run the entire thing from a pure statistics point of view, and from that pure numbers point of view, you can aim for 35% or 30% with a tighter stop loss. It is the same system, so you can manipulate it if you know what I mean. Thanks a lot.
Oh yeah, I agree with that. You can definitely make it worse. You can definitely make it less. And I think we're all, we're all creating these systems and doing the trading without emotion and without paying it. I don't really care what the market is. The famous Richard Dennis quote: "I can put my hand over the name of the market on the chart, and I know exactly what to do." I think the optimal stop loss, as far as making money, and is the same as the average loss without using a stop loss. So I'm like, okay, let's just use a stop loss. And things can be different in the future, where we could hit some trades that we're having big, huge losses that we could have. And so I'm just like, anytime I can add some safety and it's not going to cost me, I'm just going to do that. And I think, I don't know if you meant to give me this impression, but I got, when you were talking, I was thinking of another thing that I hear people say that you may not have meant to give me this impression, but it just popped in my head that a lot of times people are talking about the trend. The trend is reversed, the trend hasn't reversed. I got out and the trend, the stop loss made me get out, but the trend was still good, or whatever. And the trend is not over until my exit gets hit, my breakout exit, for instance. And I kind of understand all of that, but I don't think, as I've said before, I'm not a trend follower. First and foremost, I'm a systematic trader with my system. And when I look at my system that I've back tested, and I like it, and looks like it's made money historically. Oh yeah, it does participate in these trends, but I'm not really focusing on, wow, man, why did I get out? Because the trend is blah, blah, blah. It's over, it's not over. The stop loss got me out. I don't really care. I'm following this approach, these rules, and I'm system trader first. And I obviously, it looks like I'm participating in the trends with this system, but and that's fine, but I'm not trying to be in trades when the trend is up and be out when the trend is over. I am applying this system that, based upon the back test, the future, this is going to be my best guess for the future.
Actually, it was a very bold statement, what a moment ago Jerry Parker has mentioned, in the fact that he said that I'm a systematic trader first and the trend follower second. I don't think that we've ever discussed the identity politics of trend following here before. So that's a new subject. So, how do you define yourself? Are you systematic traders first, or are you a mean reversion trader or trend following trader or relative momentum traders, or what is your orientation? Do you identify yourself with your trading orientation, or do you just take a step back and say that I am a systematic trader and that's how I identify myself? And so far, to be honest, I've always thought myself, my identity politics about trading has always been I'm a trend following trader. So, that was, so I just need to think about that. And I'm just curious how others would identify themselves. What about you, Richard? How do you identify yourself? Are you a systematic trader?
I'm an outlier hunter, Alp. So in that decision of just focusing on outliers, I'm deliberately closing my opportunity set to other forms of price pattern or other forms of trend that aren't outliers. But I'm deliberately doing that on the basis that I understand that these outliers that deliver the greatest bang for buck. So any sort of changes to my systematic process that I do to try and target other forms of alpha compromise that ambition of what I'm trying to achieve with my singular focus towards outliers. So I recognize that it might only be 10% of my trades that are ever going to be profitable. I'm willing to sacrifice the benefits that might be achieved through the 90% of trades that I exclude on the basis that I believe that I am most efficiently allocating my finite capital to something that I believe gives the greatest bang for buck over the long term. So the highest wealth over the long term. And so I'd definitely say my numero uno would be I'm an outlier hunter, but it's applying a systematic process deliberately constructed to target those outliers. And that systematic process is the basis around that philosophy because it's excluding other forms of alpha.
Hi guys, can I ask you a very, very, very basic question? Well, Jerry, when you said that the performance is the same with and without stop losses, you're just saying just that. Like if you don't use stop losses, you get the same result, and when you close the position on the opposite trading signal, for example, you have a long cocoa position because it broke a breakout, and then what you do is you just keep that position until there is a short position for that cocoa. Is that what you say?
Well, you keep the position until the exit gets hit, the trailing stop. So you buy a 100-day high, you get out at the 100-day low, and then you go short at the 100-day low or whatever. Oh, get out at the 50-day low, and then you go short at the 100-day low. And or you buy the 100-day high and you take a stop loss based upon ATR. I don't know if I didn't mean to say, I'm thinking about this now. I didn't mean to say you make the same P&L. I don't remember, but my guess is yes, you make the same P&L with or without a stop loss, as long as the stop loss is that optimized stop loss. Okay. But I said it's the same average loss. That I remember is absolutely true. But same P&L, probably. And so my point was, if there's nothing to be gained on the back test by not taking this stop loss, add that risk in. Richard educated me a while back on it's reducing risk or reducing something. It was, and so I thought, yeah, that's a great way of looking at it. You're reducing this possibility of problems. So if you do a 50, 100-year back test, and it doesn't matter if you take a X ATR stop loss or don't use stop losses, then I would say let's use the stop loss. because what if the future is worse? I'm always worried about it being worse. And okay, so I feel like that on Alp's comment, I wanted to say, I say both things. I say that I'm trend following trader. Nobody says it more than me, trend following plus nothing. But if you're asking me what the trend is and insinuating that I must be a good boy and always be in gear with the trend, well, then I'm going to say, no, I don't care what the trend is. I'm following my system. And it's impossible for me to even think about what the trend is doing apart from my system telling me what the trend is doing. But when my system gets out of a trend, is the trend over? No, that trade is over. My trading looks like it's following trends, and it is, but I can be long system 1 in the British pound and short system 4 in the British pound, and I think I probably am, like right now. And so I've got these schizophrenic systems, one's long, one's shorts, both are trend following, both are telling me that the trend, one is saying the trend is not over, the other one's saying a new trend just started. All I know is the back test says, hey, trade both. They both make money. They both hunt outliers. They both stay in these trends and make a fortune. But don't try to pin me down as, hey, dude, the trend is over. What are you going to do? I'm a systematic trader. I've gone. I can.
That's so spot on, Jerry. It's spot on because it's your systems that are interpreting what the trend is. It's not you, and so it's not me. So when people are saying the trend is over, for God's sake, my systems haven't said that at all. My systems are saying that the trend is valid because I'm still in the trade, and it's a totally relative concept because the interaction between your systems and the market price is what creates the trend in your solution. And so it's not a one-way story where you're just looking at the market price. It's how your systems are interacting with that market price that determines whether you're in or out of the trade. So the trend is defined by how your systems interact with that market. It's a two-way sort of system interaction with the market price that defines what a trend is. So each of our systems is going to define a trend differently. It's not up to us to say what the trend is. It's up to our systems that we deploy in our systematic process that say what the trend is.
Yeah, and the next time I'm in London and Alp takes me back to that bar to get a drink and we sit down and we start talking about trading again, he's not going to start telling me what markets are in an uptrend and what markets are in a downtrend. He trades hourly bars. And so it's the same thing. Even if you're medium to long-term trend following, you can't sit around and tell me what's going on in the trends. It's only system specific. Obviously, it's hard to find a good system that wouldn't have been short the interest rates a year or two ago, right? At some point in time, dude, you got to get short. It's the 500-day low, right? So that, in the extremes, the trend is up, the trend is down. But I wanted to also say that, I hunt outliers as well. I'm an outlier hunter trader, but only because the system tells me that's what I should be. I want to maximize my return. I'm very concerned with the risk of my trading. And so the computer says, well, if you want to preserve capital the best, and you want to make money, by also at the same time being very concerned, equally as concerned or even more concerned about preserving your capital, you got to be an outlier hunter. And
that's exactly right, Jerry. Exactly
so
right.
It all begins. I know what I want to do. I want to be an outlier hunter. I want to do that. It suits my personality. But look, if the computer tells me, well, I'm sorry, the small winners don't pay. The large winners don't pay for all the small losers. It never has, and you have no reason to believe it ever will. Well, I'll do something else.
I approach this entire game by saying, all right, I don't really care what I trade, provided it makes me the most money. That was the basis of my research project when I first got into this game. And it was through my research and through my systematic backtesting processes that told me that the solution was become an outlier hunter. That's the reason why I am one.
Yeah, well, obviously, when I was taught how to trade and I was given money to manage, I was expected to follow those rules. And I was just really lucky that I had amazing mentors, who I had every reason to believe that they were correct, and they had done all the research, and they were just telling me a shortcut. There's a little shortcut to life. If you want to be successful, you probably want to take our money and do what we tell you to do. So it was easier for me. I told Mike yesterday on that podcast, it would have been much better. I would have been much better trader if I would have had 8 years there or 12 years there, because our time there with those guys was way too short. And having this mentoring and this confidence building and being able to go through good times and bad times with people like that and talking it out and getting deeper and deeper into their understanding and their research would have made me a better trader probably. But it's a bad analogy, but it's kind of like saying to someone, here's a manual, now go be a Marine. And that's not how it works. I mean, there's probably a manual, but there's a lot of real-time stuff that you're being forced to do and forced to learn. And a lot of us are going to be heavily influenced on what we're going to achieve, positively or negatively, by the people we learn from and we listen to. And I thankfully owe it all to those guys. And I owe it all to them so much that I haven't really changed very much, except become longer term and with the ability to add more and more markets. So that is that's the evidence that there was no reason to ever change very much.
Actually, Jerry, and everyone, there's a really good episode on Top Traders Unplugged with Rick Rule. It's the latest one released by Niels, and so Rick Rule is a commodities specialist who particularly focuses his investment in mining companies, understanding the nature of the mining managers and understanding the nature of the resources that they're mining. And he was talking about the biggest trades that he's ever had in his life. And there was 2 examples he gave where I think he invested in projects that had an estimated value of $9, leading to a value of $250. It was that sort of level of significant outlier in those trades that made his nest egg. There's basically 2 trades in his life that set him up for life. And really that's our whole modus operandi. There will be these instances where we are totally surprised by the level of returns generated through our systematic process, but it's through being in the right place at the right time. And that's not a luck statement. That's a statement of being heavily diversified, small bets across many, many different markets, and you allow your systems to ride those outliers, and that turns a statement of luck into a process.
Yeah, I really like that. I'm not finished with it, and I'm going to listen to that podcast again. I really like that guy. I have to admit, though, I kept going. I thought he was like, I got the feeling that maybe Niels thinks this is getting out of control. And I didn't really know if they felt like they were in control of their own podcast. And
yes, exactly.
And I kept thinking, this guy's a kook. No, he's really smart. No, he's back to being a kook again. No, he's really smart. So I think he's really smart, but I think I'm almost done with it. And I haven't heard too much about trading. He has these, world views and complaints of politics and, I don't know. It's different things going on with him. And it's all kind of interesting and funny. And I was like laughing. And I have crazy friends who are kind of into trading a bit, I guess, but into more other aspects. And I sent them this podcast, and I was like, "Hey, you may not be into trading as much, but you should listen to this guy." And they said, "Oh yeah, I love this guy. It's really a great podcast." So I'm going to do it again. Let's do it again. Then I'm going to go and tweet all my favorite parts. But he is a pretty unique guy.
Actually, Al, what did you think of Roy Niederhofer? Were you sort of nodding your head up and down in relation to his short-term trading tactics? And I noticed that he explicitly said he is not a trend follower. And in his short-term trading world, you've got to be distinct in separating yourself as a trend follower because the models are entirely different. Have you listened to that, and did you agree with that?
Actually, I have, because at the moment I'm on vacation in Antalya, Turkey, and I do have. So Antalya is a city of, it is in Turkey, but actually, this is a city of Russian. So I would say a lot of my Russian friends are here in Antalya. Antalya is in Turkey. In Turkey is number one place for Russian tourists, and I'm enjoying myself a little bit. And this week I've only listened. Rob's interview, to be honest, but I will listen Roy's interview possibly next week. But in terms of what you have mentioned there, what is the difference between taking 200 days breakout versus taking 3 days breakout, 5 days breakout, 7 days breakout, 9 days breakout? There is none. So your distribution is going to be lower. You will be working with 5-minute bars or hourly bars, but all the principles that we've discussed will be applied accordingly. So, as far as I know, there are many traders who use, Markov chains in their trading processes or multiple strategies. So, perhaps what he has meant is more attuned to that sort of thinking and systems application. But if you're a pure trend follower, I'm I'm pretty sure that because the work that I'm doing is pretty evident that there is really no difference between taking 5 days breakout versus 200 days breakout. And of course, you can take the 5 days breakout with trading the intraday bars, obviously. If that would that answer your question, Richard?
Yeah, that helps, Alp. But but let me know your thoughts maybe next week on the interview with him. I just noticed that both Roy Niederhofer and people like the Quest, Nigel, and even Crable, they're using techniques that have got many more overlays than we do in our models. And I'm just wondering whether that's a necessity in short-term trading for these application of many more overlays.
Oh, yes. I mean, I think Oleg has mentioned the same thing as well, isn't it? So, using overlays or not using overlays. So I say I can work my systems both ways. It's no brainer that if you want to use a 200 days moving average and started to take the stocks long only, long and short only above the 200 days moving average, it's just going to work smoother. And, also based on my research, I can share with you that the more volatile the market, the less overlays that you would need. So, commodities is possibly, if I wanted to trade commodities only and stocks only, or only commodities and stocks, I don't need any overlays or whatsoever. And overlays in my testing, just making things better if you wanted to trade more less volatile markets. So, but overall, I'm not using any specific filters, but using filters or any other overlays, it just makes things much more smoother. But there is a cost to it, and like the other podcast of Florent Court, I guess they were talking about operational inefficiencies versus inefficiencies, right? So because they were saying that there are lots of operational inefficiencies in trading alternative markets, especially China and emerging market securities and instruments that are out of the exchange, basically will subject to a lot of inefficiencies. And the same thing applies to short-term trading. It's hugely operationally inefficient. It's nowhere taking the 200-day breakout. It's just because you're using a huge set of algorithms to be able to trade, more than 2,000 trades per year, sometimes 5,000 trades per year. And, if you're going to trade 2 to 3 day average duration, then it's going to be really more to 5,000 trades per year. So, it's those overlays are mainly there. You got basically way more options with short-term trading. Okay, there is no because Jerry Parker usually says that we have found the most efficient long-term trading, and it is what we do, and this is how you do it. Period. Okay, so this is what Jerry Parker says, but this is not the case for short-term trading. So there is at the moment no one actually. I mean, what I'm trying to say is there is many ways to skin the cat with the short-term trading because you're very versatile. So you can use overlays, not overlays, number of markets, number of trades, operational inefficiencies, and either way, you just make money. If the systems make money if you code the transaction costs into it. So there are many more options, and you just make a call. And I'm sure in 5 to 10 years' time, many people will be trading hourly bars or 5-minute bars. Thank you.
Thanks, Alp.
Hi, Richard. I just wanted to say as well, I trade on a more short-term basis. I still kind of consider myself a trend follower in the fact that it's a sort of positive skew type strategy. But I actually did some testing not too long ago, just looking at the difference between the system that I have, which does use a few overlays, and just comparing that to one where I sort of strip all that away, and then I just basically put in a simple Donchian channel for an entry, but I keep everything else the same, like the exit strategies that I use the same. And what I found out was that the win rate that I have was about 7% lower, but the fact was that my win rate that I have in my short-term strategy is quite low to begin with. So having a 7% increase in win rate was turning what would have been like a sort of break-even kind of system using the simple entry into one that was quite good.
Many thanks, Agile. Does that mean that if you traded a simpler system, if you diversified more, would that benefit be ironed out in the long term?
So diversify how, sorry?
So let's say you've got a naive system that has a 7% deterioration in the win rate versus one with overlays in it, which has a better win rate. So I'm thinking, okay, that's for the individual return stream for the market that trades. I'm thinking whether that can be compensated by even more diversification with your naive models, in that the negative sort of outcomes of the lower win rate and possibly the higher volatility would be compensated by better, more diversification, smoothing that all out.
Yeah, sure. I mean, so I guess when I'm testing this stuff, it is on a very diversified basket, so stocks, commodities, and stuff. But it's just even with that diversification, it's still the win rate is lower.
Many thanks.
Yeah. I also just found the Niederhofer interview quite interesting as well. Just in terms of what was it that he said? Just the execution costs.
Yes, I heard that as well. So he challenged that whole notion that short-term execution costs was material in short-term trading. He challenged that notion.
Yeah, I tend to agree with that as well. I mean, with because I trade on interactive brokers. I mean, there's quite a few good sort of algorithmic execution stuff that you can use. So it's not. I must say, yeah, it hasn't really been a problem for me.
Thanks.
Yeah, that's interesting because I guess I had a misconception. And I want to go back to what Alp was saying about. I thought your trading, number one, I thought your trading, Alp, was pretty much one entry, one exit, and a stop loss. So now I'm thinking that no, it needs to have some sort of overlay. I'm not sure what that means, but any sort of philosophical explanation would be interesting to hear. And then number two, I used to make this big distinction when you would talk about your trading between the 1 day low, the 5 day low, whatever you were saying there, and the hourly bars. And I would say, okay, maybe the hourly bars. I could see how hourly bars and a Donchian channel, turtle channel breakout could work better than this 1 day low, 2 day low, 5 day low, 5 day high thing. But you started using that and as if it was sort of the same thing.
So look, first of all, last year, for the entire year, I haven't traded without a filter on overlay that that we have discussed, other than the correlation filter. But this year, I've decided not to use the correlation filter. Okay, so I'm trading like with one entry, one exit, one stop, plus the correlation matrix that is being updated every hour. So so that was the overlay that I have used, and it has helped me to keep my drawdowns pretty limited. So it was good, but it's not the only overlay that you can use. And I don't like using I don't like using a lot of filters or overlays. But in my tasting, if you use filters and overlays, it still works because the number of transactions are in the realm of thousands. So, if you want to filter, how are you going to filter this? Well, you're going to put a market regime filter, right? You're going to put something like or a 200 days moving average, or you're going to put something else like S&P 500 filter. It all works. If you put a market regime filter, it works. If you put a something else, another filter, it will work because of it is a volume business. I would say, that's the main distinction. So I'm not quite sure whether this answers your questions, Jerry. And in terms of the time frame, yeah, I mean, if you're gonna trade, what is the default short-term trading system? Let's say, Nicole Collagen has mentioned 5-day breakouts. All right, and last year I have traded something very similar to 5 days. So it's a perfectly all right system, but it's generating thousands and thousands trades, and you cannot trade 5 days with the daily bars. Yeah, that's not possible. So because I'm entering and exit intraday. Can you imagine? You need to calculate where the stop has hit during the bar. Daily bars would not work. So you need to be using hourly bars minimum, and 5-minute bars is even better. So, and this means that you need an algorithm which is capable of churning 5-minute bars with 100+ markets and you would want to trade this thing, of course, every 5 minutes, because it's 5 minutes bars. So that algorithm really needs to be pretty fast as well. So, and you need to download the data ideally from your broker. It would be the best way, because you don't want to be trading with the data of a third-party provider, because there will be differences in the data stream. And such an operation is just going to be a little bit inefficient compared to, let's say, 100 markets, long-term trend following, where you have 100 signals per day. I'm not quite sure whether this answers your question, Jerry.
Yeah, I think you were saying you're looking at hourly bars, but you may describe it in terms of days. So I think the granularity of getting to those hourly bars, I think, is a game changer. I think I can see how it can work. I put 5-minute bars, hourly bars on my quote machine, and I put a channel on it, and I see a lot of trends. However, I would say that from our kind of ideologue point of view, rather than we're very confident that obviously the overlay makes it profitable, right? But what we're concerned about is we would much prefer to trade without the overlay for long term, for short term, for hourly bars, 5-minute bars, and see that level. Like, yes, that would be the much better to say, I don't need any sort of overlay. Like, I don't need an overlay on my system. My average trade is very large. My average trade is a big winning trade. It's 3 to 4 ATRs. So I don't want to be in a situation where it's 1 ATR, but if I do this overlay, now I can get it to 3 to 4. Now I want the opposite. That's the battle between managed futures CTAs and classic trend following.
And I want to say that it's very important for me personally in such type of trading, it's our exits. So if we do all in a classical way, and the classical way is the best way, of course, but the classical way, it's a medium to long-term way. And if we do hourly bars in a classical way, we are whipsawed too often. And so maybe, I'm not sure with 100%, maybe we need another type of exits here, not, for example, 200 enter and 200 exit. It will be a lot of whipsawing. Of course, it will be profitable in the end of the day, of course, but not so profitable as medium to long-term trend following. So maybe another types of decision here. I think so, because for me, short-term trading can be profitable, of course. I'm not very sure what will be with the short-term models in a very massive crisis. I understand what will that our classical trend following will survive in every crisis, I'm sure. But I don't know the answer what will be with the short-term trend following model. But it can be, of course, be profitable, and I think that we must need maybe even take profit decisions, something like that, ensemble of models for exiting, some not classical ways, maybe, but short-term is another. I think so. Short-term trading needs improvements, and the long-term trading don't need any improvements because it's perfect.
I hear what you're saying, Oleg. And look, I suppose I've done a bit of experimentation in short-term trading, and what I found was that when I applied naive trend-following models to the short-term trading environment, I inevitably had to do things to juice up the performance. So I'd include a regime filter, or I'd include some other form of overlay, which naturally significantly reduced the trade sample size, but in the process improve the performance. And I kept on scratching my head saying, am I over optimizing here? Am I curve fitting? Because what I found was that the more I did this, the more I found that the properties of the system that I was deploying was being more configured to the nature of the discrete properties of the individual markets I was trading themselves, as opposed to a naive model that can be universally applied across all markets. And so, for instance, I had a lot less confidence in applying a more complex model to new markets in my portfolio because of the additional parameters and the additional regime filters, etc., which made me a bit more unsure whether they'd work well on those new markets I introduced into the portfolio. Whereas with these naive models, I was exceptionally confident that I didn't actually need much of a data sample size for any new market to be able to introduce that market into my portfolio and trade it confidently with those naive models.
So, I mean, with the short-term models, if you just trade intraday, if you open up with Asia and if you close your trades with US, I've tested that one as well. So this is just a complete opposite. You end up with like more than 15,000 trades per year per market. So really sample size. So this is the maximum. So if you're gonna trade 100 markets like that with a huge infrastructure, then of course you're going to end up with more than 1 million trades, right? So really sample size is, so if this is the definition of robustness, which we learned from Jerry Parker, then yeah, short-term trend following is not going to give you anything else but robustness, because the sample size is just going to be so huge with the overlay, without the overlay, with the filter. So last year I used the correlation matrix, but still ended up doing 2,000 trades. So, can someone else say that, 2,000 trades is worse than 4,000 trades because you have used the correlation matrix and you have, taken the crude but didn't take the brand? No, because it's, where there are so many trades back to back, I think, Richard, in your systems, you just need to incorporate the hourly bar to start with. And if your algorithm is able to churn hourly bars, and then you need to start implementing, you can start working from there, really. Thanks.
Yeah, go ahead.
Jump in. Thanks for the spaces. This is awesome, and I've been involved in my system here. And a question for you is, I understand focusing on the stop loss and letting winners run. Do you ever add to an open position, and how do you define when to add? And then is it the same addition based on the amount of risk? So in other words, if you're using 4 ATRs and that tightens up, are you then adding back more to the open position to get back to the same risk level? And then second question, do you ever take profits at a set target upside, or is it only when you only take profits if a stop loss is hit? Well, obviously, you're increasing the stop loss. Thank you.
I don't think I do either one of those things. I'd never change my, I think you were meant to say trailing stop. I never change my stop loss. I never change my trailing stop. It's always some sort of 50-day low, 75-day low. So that never really changes. As the profit gets bigger, I usually just have more open trade profit and willing to give back, the open trade profit and not moving it up. Breakouts don't have a tendency to move up like a moving average will. Like almost without exception, when you're making more money and you're using a moving average, it moves up every day. If the market is closing higher and higher, the breakouts don't really do that. So, and I really don't add or subtract or do anything based on the market, the profit in the trade or the loss in the trade. I have a set rules and I just stick with them. And so if I trade 4 different systems, so I divide up my capital into quarters, and I trade each system with different parameters, but with the same asset level. And so system 1 gets in first. If it goes higher and hits another breakout, system 2 gets in next, then system 3, then system 4, let's say, as the market continues to go higher. So it may look like I'm adding, but it's never based on, oh, I have this particular profit, or I'm changing my exit based upon a particular profit, or for God's sakes, move your stop up to lock in a profit so you don't take a loss. That is the worst idea ever. Why is it a bad idea? Well, you know it's a bad idea because everybody wants to do it. I cannot bear to give back all this profit. It's a small profit, probably. But I'm not going to do anything, but I'm going to make it break even. No, I've made so much money on trades where I had a really nice profit. I lost it all back. It may have turned into a nice loss. The market reverses. I never got out. It goes right back to the highs and keeps going. And that, if you backtest any of those ideas, the last one is superior. And that is, hang on until your stop loss gets hit. Do not change these exits based on what's going on in the market, other than, hey, look, system 2 gets in at a 100-day breakout. So now it's the 100-day breakout. I'll do the system 2 trade. It's all predetermined, pre-orchestrated, know exactly what I'm going to do, not really paying attention to open trade profit. Although, as we keep hitting these new entry levels, the previous entries are, somewhat profitable, I guess. Does that make sense?
That does, yeah, that does. With having the multiple systems, right now I'm just using really one system. And for example, like I'm in a position of Ethereum, doing very well on it, and I'm using the Donchian channel as for 20-day in terms of when I'm going to enter the trade, and it keeps breaking above that level. So I don't have multiple systems, but maybe that's something I can look to implement, because I'm sitting here not knowing whether to add to the trade or start to take profits on it. But I hear your comments on the take profits point. Thank you.
Good for you. Good for y'all. I'm losing. I don't know what happened. Well, I'm going to then, since I can't hear Richard, I'm not going to let anybody else hear him either. No, I'm joking. Well, we almost made it 2 hours anyways, but we'll pick it up next week. Have a good weekend. Thanks everybody for showing up. And let me know your thoughts on the new